Okay, for anybody out here watching on Facebook Live, YouTube Live, this is going to be about an hour, half hour, hour session here. We're going to break down how to underwrite multifamily here. We're getting started here in a few minutes here. I have some screens all open here. Most of you should be able to see my screen right now here. If you don't, we'll have some technical difficulties. We'll try to update it here. Feel free to chime in if you can't. See my screen, feel free to comment kind of thing as well here. We're gonna get started here in a few minutes, and we're gonna just break down kind of multifamily, some basics of underwriting it. We're gonna go a little more in depth at times as well, and try to give some good insight for people who maybe are more experienced in underwriting. This will all be based around the Des Moines, Iowa marketplace as well. So if you're in other markets, some of these things may or may not apply. So just be wary of that here. For example, one thing that's different to Iowa is our taxes and our rollback and how that all works. So I just want to be upfront and clear that all of this is based around Iowa. I also want to point this disclaimer here. I have this in my notifications here. This is in my Excel sheet. You'll see actually this is my Excel sheet that I use here to underwrite all multifamily deals here. We'll kind of go into what this looks like here in a second. But important disclaimer, just be aware information contained is just an analysis. It's just calculations. There's inherent limitations and risk while in this. It's important to carefully underwrite yourself, figure out analysis as well here. As we go through some things here, some things that maybe that are watching here as we kind of get going and get prepped to kind of think about here. So this analysis here is broken down into really about 4 or 5 different parts, depending on how you look at it. This is my analysis here that I use for my clients here. It's going to be probably a little more in depth than people are used to seeing here. We have a comprehensive summary here. We'll go what that looks like and what that all is as well. But basically what this is doing is this is going to run 3 different models at the exact same time on a multifamily deal. We're going to do best case scenario, the current scenario, and then the worst case scenario here. We're going to weight those averages here. So if you see these yellow tabs all relate back to this comprehensive summary here. And then the green relates to green, red to red, et cetera, et cetera. And then we have the market assumptions here, which again will relate back to everything as well here. So that's kind of how my Excel sheet works here. And just a few things here as well. I also have a few tabs open for anybody that wants to kind of follow along. A few tabs I use a lot in underwriting. If you do have CoStar access to this, this is a great source for data and analytics and research in commercial real estate. It's hugely important. If you see this logo here, you'll see it also in green. CoStarOwnsApartments.com, the same logo here. So any logo you see like this, LoopNet, etc., it's actually all going to be owned by CoStar. That is the parent holding company of a lot of commercial real estate data out there as well. Some other great source of information here. We have the Polk County Assessor site. So if you don't know how to access the assessor sites, recorder sites for your local area, really great information here on how to access deal flows in certain deals. And then another great source of information that I use a lot is FRED, which is the Federal Real Estate Reserve Bank of St. Louis here. Really a lot of good information here that we can use to underwrite markets. We're gonna talk about that a little bit here in the opening as well here. So that's just kind of a few things, kind of, housekeeping, getting us all started here as we jump in. It is at our timeline here. So I am going to jump in and get started here. I don't see anybody on just yet here, but either way, we're going to start here so anybody can rewatch this, can begin to kind of see how things go here as well. So I'm going to pull up actually a PowerPoint I've done recently here. I'm actually make this the main screen here. So when you're underwriting multifamily, there's a lot of ways to do this here, but the easiest thing you need to do, the first step you need to do in underwriting multifamily is you have to get information. You have to be able to look at the past to look towards the future here. So the first step you need to have when you're underwriting a duplex, a fourplex, all the way up to 1,000 unit complex is you have to get information. The most common ones to get is what they call a rent roll. You'll also hear that be referred to as a RR or a rent roll. You will see what they call YTD, which is year-to-date financials, or what they call trailing 12-month financials. What they call a trailing 12-month, they also refer to it as a T12 very commonly here. And a T12 essentially this means the last 12 months here. So this live event here is happening in September. So a trailing 12 would be back to essentially last August or last October kind of thing. So that'd be a trailing 12 months. Or that's going to give you again another example here as well. You could also get 2 or 3 years financials as well. That can be really important, especially you give more history in the project. The more history you're going to get, the more you're going to be able to look at the project here as well. You always want to look back. Underwriting multifamily is really about art and science. There's a science to it and an art to it. And the longer back you can look, the more you can use science. The shorter you have to use a little more art form and a little more experience breaking into it. Step 2, you're going to want to look at usually the rent roll and the rents. You just want to see, are there varying rental amounts? What are they charging for apartments? You know, are some charging 1,000, some charging 600? Look for discrepancies. Look for gaps. Look what they're charging in unit mixes, 1 beds or 2 beds. Those can vary in rental rates quite a bit. Here, 2 bed, 1 bath, 2 bed, 1.5 baths. You know, 2 bed, 1 bath that are facing maybe the ocean or something. If you're on the coast, can change quite a bit here. You'll want to also look at the lease dates and start dates. If they have that in the rent roll, it's really important. If they have, if better, it's good to look at longevity. If you see tenants have been there for a long time, that's a great analysis point. It gives a lot of insight as well for a lot of different reasons here. Sometimes if people in there a long time, it could be good. It could also be bad. It means rents maybe haven't been raised for a while. Could be an opportunity there here. So really important to check lease dates as well as security deposits. And the most important thing, especially recently, is this last one here, concessions. Concessions means someone might say, I'm doing a 12-month rental rate. I'm giving 1 month free. That's really 11 months of rent, not 12 months here. And that works like a 92% occupancy rate because 1 divided by 12 is 8%. And so that kind of can change things as well here. And I'm just going to kind of keep going through this all. These are just the steps here. We're going to kind of practice some of these steps here live in person, you know, with some of my analysis here next. You need to also review financial documents, look for the annual income here, discrepancies in the income, rental rates, etc. here. Look for just higher than normal expenses. We'll go through this as well. But if you see something that's really popping out, like, hey, these months are all showing, call it $3,000 a month in water bills, and 1 month showing $8,000-9,000, it's point to ask a question here. Just look for gaps, look for discrepancies. You'll see it a lot in repairs and maintenance and capital improvements. You'll see a lot of discrepancies there as well. And from there, you're really going to start building a historical financial model here as well, kind of tying this into like the here and now. This is where we build a lot of this comes into building the analysis of what's currently happening in the property, what's currently doing here as well. That's where you have that step 4 being built in as well. We're going to go into this as well. Just going to kind of skip ahead here instead of going through examples here. We're going to kind of do everything here. What's really important when you are looking at properties, there's a couple things. One, you really want to get good at evaluating and looking at the revenue and the income from the property. Really figure out how does it compare to other properties here. This is where it's really great to go to. It's so simple anymore, but go to apartments.com. You know, if you're looking at Des Moines, Iowa, and I can't spell, but if you're looking at Des Moines, Iowa for apartments, then you really need to be looking at what our rent's charging right now. So Cityville here is $950 to 12, you know, 2810, $845 to $1,600. That's obviously big gaps here as well. But one of the easiest things to do when you're underwriting properties here is you need to figure out whether this property, what's the story of the property, and does this property have an income problem or an expense problem, or is it just cash flowing how it is as well here? So you really need to look at the income. Maybe the rents are under market, maybe they're at market, I don't know. That's the first thing you need to do is really review the revenue, see if there's ways where you can actually increase rents or you can actually add amenities as well. We're gonna go into what this means here. This is called LEA, Location Economic Analysis. We're gonna talk about that here a little bit in practice as well going forward. Don't get too hung up on that just right now here, but we're gonna talk about that. And then after you've looked at their income, here's some just examples we have here for anybody watching of just income sources you can get or potentially add to your revenue here. You have utility bill back, which is also commonly referred to as RUBS, Resident Utility Bill Back System. That's utility bill back. Tenant insurances, service for a fee, move out fees, application fees, very common. Early termination fees, again, very common. Pet fees, late fees, storage income, garage income, laundry income. all very common. Depends on location, depends on asset type as well. Some of these may or may not apply, some do, some don't. It really comes. I also want to caveat here, especially with these pet fees, really make sure you know your laws wherever you're at, where you're investing. There are laws based around pet fees if you are having service animals in your property or not. That can really change things up quite a bit here. So if you are looking at pet fees, make sure you are knowing what that all entails, and what the laws around that entail as well, because that can change very much by location and area. Getting into it as well, looking at your expenses, you always want to start off with your fixed expenses. So you want to focus on the taxes and the insurance. You want to focus on the things that you really can't change at all. After that, then you can go into what we call more the variable expenses, which are utilities, repairs, that kind of thing as well. But realize that the first thing you want to do when you're looking at a property is you really want to review where everything's at right now, and things you cannot change, which is literally your taxes, your insurance, your mortgage, things like that. When you're evaluating property here, once you've done your fixed, expenses here, you looked at your insurance as well. We'll talk about what that looks like here as well. Insurance, I'm not gonna get into too much here, but just know as we talk about it, insurance, there's a lot of types of insurance. There's actual cash value, there's deductibles, replacement value. Insurance has been a real nightmare for underwriting multifamily the last few years. For anybody who's in the business knows, and it's been really tricky here. So definitely consult a qualified insurance agent with doing insurance. Make sure to get ideas of premiums and copies before you are buying property, because it can change quite a bit here. You might be looking at a property that's been insured for a long time with someone. It may be a very low premium compared to what it'll cost to insure when you buy it as well here. So really important to get a strong insurance agent here as well, because that's where the historical expenses of taxes, insurance may not translate to you owning the property here in the future. It could really change things up and really affect your values quite a bit here. Once you've done that, again, so like I said, the variable expenses here, these are some of the variable expenses you have: repairs and maintenance, utilities, trash and garbage, lawn and care, snow removal, also called property maintenance as well, pest control, cleaning, management, lease up, reserves, and capital improvements. All these are things that you can control or the previous owner could control as well. You may have your own trash service about, maybe a cheaper lawn care, snow removal, pest as well, cleaning, up to you. So these are all things that you can control a lot more of. And so it's really important to also know what these are going to cost for you when you're owning these properties, whether you need to hire this done a third party, you're going to do it yourself, et cetera, et cetera. That can really change a lot of how you underwrite a property, especially, again, looking at smaller multifamily. Anything that's like 8-plex, 12-plex, 16-unit complex, 4-plex is really common to see this. When you are dealing with duplexes and 4-plexes out there, some of these expenses may be handled by the tenant. You may have tenants paying their own utilities, tenants taking care of their own trash, garbage, lawn care, snow removal, especially in a duplex as well. You may not need cleaning or pest control for a duplex or a 4-plex. So some of it's going to vary a little bit based upon where you're at and what you're buying as well. We're going to talk about that a little bit more as well. Once you've kind of looked at all the historical income, you start looking at their model of pro forma, what it could do, value add, if there is a value add. What we always like to say is find the story. Find the story, ask for the story. That's really important. The story is really of how do you make money? How do you get to a point of profitability, of owning an apartment complex, a multifamily asset for value, really making money out of it as well. One thing I like to add here is dynamic or static assumptions. I'm not going to go into that too much here. It's probably a little beyond this live event here. But dynamic assumptions are essentially short-term trends. So for anybody who remembers COVID, we saw a huge spike in rent growth and all these other things happening in the marketplace. We saw a lot of things happening that were really just short-term trends. They were not long-term trends as well here. And so static trends, I would say static trends are more historical trends, usually 20, 30, 40-year metrics. Like, for example, we know that to the south, to the southeast, southwest markets, Florida, Texas, Arizona, people are moving there, has been over the last 20, 40 years. It's a static trend. It's not dynamic. Dynamic trend is something that we're seeing rent jump up by 10% over the last 4-year period. That's a static trend as well. That's more based on market underwriting, which we're going to talk about briefly here. But make sure you are looking at that as well, testing your assumptions as well here. And then step 12 is just don't forget to be specific on the story here. When you are doing this deal, make sure to tell the story to your banker. If you're partner with a banker, maybe your family, your partner, whatever it may be. If you have a spouse, maybe that as well. So really understand that when you get done underwriting, it's not just the numbers, it's the story the numbers tell you. And that's the story you're going to want to be talking to about with your agent, with your banker, with any partners you may or may not have as well here. So that's what's really important here. Again, we always want to remember and think about that underwriting multifamily is all about underwriting the story, figuring out how we can make money owning this property here as well. Some general rules of thumb here. These are general rule of thumbs here for anybody out there who's rewatching this or watching it right now. Highly recommend you just take a screenshot of this here. These are going to save you a lot of money here. But generally speaking, your expenses, these are rules of thumbs. Your A-class apartments are going to run between 25 and 35% of gross income. So for example, if you're making $1 million per year of gross revenue in an A-class apartment, you're going to have about $250,000 to $350,000 of expenses to that gross income. That's what that means as well here. And then B, C, and D. For a general rule of thumb, if you really want to make this super simple, is A-class apartments or anything built in the last 20 years. So as of this video, that's 2025. Anything from 2005, 2025 is going to be A-class. Anything that's built between 1985 to 2005, probably going to be B-class. 65 to 85 is probably C-class, and then older than 1965 is probably going to be a D-class apartment complex as well here. It's just a general rule of thumb. It's not perfect, but it's going to help you kind of figure out real quick math. For anybody out there who needs just that quick rule of thumb, I'm going to go look at my first duplex, my first fourplex, my first apartment complex, etc. That's kind of how we do our classifications. Just figure out 20 years. This is 20 years new, 20 to 40 years, 40 to 60, 60 years plus for being old. For your repairs reserves, again, some numbers, 3 to 5% of your gross income is going to be in repairs, reserves, repairs, repairs, reserves as well. Again, just very general numbers here, rules of thumb that'll make it easy and quick for anybody out there who is looking to analyze multifamily and do it on a very quick high level here. For a simplified answer, if you want to be just 50% of your expenses, or if your income's going to expenses, so for every dollar you get, half it's going to expenses. That's a real quick way to come up with your net operating income, your NOI. For anybody who knows what NOI is, hopefully we all do as well here. So that is kind of just the opening segments here. I'm going to pull up my Facebook. You're going to be watching for any live who still has any questions. I don't see any questions in the chat. I don't see any comments here, so it looks like we should be hopefully okay. Everybody's going good here, no comments. So we're going to keep talking about underwriting here as well. So one of the things that I see multifamily people do a lot of times, especially one of the newbie mistakes, is analyzing property, and that's great. But the one thing I see people forget the most to is underwrite the overall market. Is the market growing? Is it not growing? What's going to be the future demand here? Something we talk about for anybody who's been through CCIM, Certified Commercial Investment Member, which is what I am as well. They have a 102 class. It's an entire week-long class, and it's all about how to understand multifamily supply and demand metrics. Because here's the thing, if you're buying an apartment complex and you're buying it in Gary, Indiana, where nobody's moving to, you might be buying a 10 cap property, but it might be going down in value because no one's moving there. On the flip side, if you're buying in a very high growth area, then the market might be going up. You might be still be able to buy a 5 or 6% cap rate deal and watch the value increase as well here. So what we need to do here, this is where CoStar comes really, really helpful, is you can go here, you can pull up some markets here and kind of read more about markets. But for this case example here, this is what we're looking at for the Des Moines marketplace. The first thing you need to do is you need to figure out how big is the marketplace. So especially in bigger markets, there's like Chicago, New York, Miami, Denver, Dallas, etc. You're not going to get the entire market. So you need to build either a drive time population, which is usually your commute time, or you need to just use a radius as well here. So for example, what I mean by this is that in Des Moines, Iowa, The average drive time is about 20 minutes here. In 20 minutes, you're going to have a population of about 500,000 people, give or take, in the Des Moines marketplace, give or take as well. Now, what's interesting here as we go to properties here, I'm actually going to pull up here and show you what this means on a perspective here from CoStar. That's why it's so important to have CoStar here as well. I'm actually going to pull up this properties here. We're going to pull up multifamily. And we're actually going to pull up, I believe the property is, what was the property? 15th Street, Des Moines, Iowa. And what was that property? Let's not do that one. Let's do, what's my property address here? Zeroed out here. This is my example I have pulled up for anybody who's looking and watching this. 15th Street Apartments is, I do not remember, I think it's 4911 top of my head. Yep. Here's what I can do. I know exactly what this is at, so we're gonna do this all on the fly here, exactly where I'm at. So we're gonna pull this out. We're gonna go way back to where I need to be, which is Iowa. Good news is I know exactly where this property is at. So I can zoom in on it at a very high, quick level. And here we go, 3315. Yep, so this is the property that I'm going to analyze here live. It's an old property. I sold it years and years ago as well here. So what I'm actually going to do, I'm actually going to go back here. I'm going to type in 3315 East 15th Street, Des Moines, Iowa here. Now what I'm going to do here is I'm actually going to do travel time. So I'm going to do 20-minute drive time from 3315 East 15th Street. And I'm going to do no traffic. So what that does, you may have noticed here, so this is going to build a drive time map here. This is not a perfect circle. It's not a perfect radius. So this is going to be more accurate than just pulling from a generalized thing as well. That's why it's really important to get a professional agent or professional underwriter to help you with some of these things that has access to softwares like this, because they can build a more thorough model of the overarching marketplace and build a better model for you to underwrite the property here as well, because this is going to be very different here. But what we're going to do here is we're going to look at, again, what's the commute time average. For average commute time for any area, you can go to this Federal Reserve Bank of St. Louis here, just type it in, what's the average commute time for really anywhere. It'll pop up and it'll give you that as well. Then what you want to do is put in the population. So population, demographics here, again, you could use this as well. We have our analytics over here, or you could utilize the Federal Reserve as well. For this case, trust me, it's 502,000. We'll put it in. You'll also want the average household income, average household value. The reason this is so important is we want to really designate whether this property or this area is going to be a rental area or whether it's going to be an owner-occupied area here. So really important to have those numbers when you are analyzing a multifamily deal, because you want to see what the market like it or around it is like as well here. Then you want to put in the average rent. So in this case, we're going to put $916,000 or $916 here as well here. So this case, we're actually going to put $1,110 actually. We're going to change this up and we're going to add that. And again, this all comes back to underwriting a marketplace. It's really important to do this first because you want to make sure our underlying assumptions are correct. Next, we're going to look at how many units there are, 58,234. So we're going to do 58,234. Then we're going to number of units developing. This is where, again, it's really important to have CoStar access as well. 1,174. 174. And we're going to do absorption rate. What absorption rate means is how many units of those 1,174 were absorbed, how many were leased up. In this case, we're going to do 153 were leased up as well. So that's what we have there. And Reason we're going to actually add in vacancy rate, 0.081 right there. So what we have is I do all my numbers here on this average, right, in this case. And then what we're going to do as well, we're going to need to add a growth rate for the market. So for the growth rate, again, you can go to Fed Reserve, figure out how fast that city or that metro market is moving and growing. For this case, we're just going to use 2.5%. Actually, the Des Moines market's growing by 2%. Let's just do 2% instead. And what we're going to do is we're going to change this by 2.5 if it's in a conservative area, and 1.5 here. And then we're going to look at the average rental home ownership rate, again, to see whether we're in a rental market or in a ownership market. And then household size. These are all numbers that are going to drastically affect everything as well. And then also we can build in this rent projection as well down the bottom. Again, really important. These numbers up top help us figure this thing out. But what this will do, I'm going to just kind of save you the synopsis here, kind of just zoom in on this as well. What this is doing is saying that right now we have 500,000 people. We're growing at 2% per year. So we're going to have 512,000 people in one more year in the Des Moines marketplace. That means we're going to have 4,000 new houses needed. Because we have 4,000 houses, 30% are going to rent, 87% are going to own based upon this number up here, which means we're going to have 1,255 new renters. Now, of that, there's the average household size of 2.5 people. So what that means is that we're only going to have about 400 or 500 of those are actually going to be needed as well here. Then that actually builds in the growth rate percentage-wise. And then we also get the growth, rent versus household income as well. So we want to see if it's affordable market as well. But this will help us predict and analyze what will be the growth rate or the vacancy right now. So you can see right here, number of units. Future vacant, we're going to have 4,000, but we're predicting by next year we're going to have 3,500 vacant. So we're going to see vacancy rate go from 8% to 6% in this example here. And that's using the average here. What I then do is I then take all these numbers and just copy and paste them all the way through. And this is where I run my multiple models scenario of everything. I run it better, worst case, etc. So again, best case scenario, 5.5% vacancy, average case 6%, worst case 6.63. And then again, this is going to be projections on what I think rental growth will do. We can do expenses. I always run based on what inflation has been over the last 5 years or so. So if you want to see what inflation is for the last 5 years, build that in as well. Really important, again, to do this first when you're underwriting multifamily here, because again, the last thing you want to do is buy a property, think it's going great, and then the market's going down. Don't fight the market. It's a big ocean. It will win every single time. So for anybody out there who's watching this, rewatching this here, do not forget to do this here. And again, I think it's important to do all three models as well, because it's going to give us a better synopsis, better view of where things are going as well. Now, get into the example here. What we're going to do is we're going to pull up this 3315 property. This is a property I sold a long time ago. So we're just going to write 3315 East 15th Street as you're watching me underwrite this here. And that was 49 units. So let's say 50 units easy. 50 units today's market sells for $70,000. Let's say the property is asking for $3.5 million. This is just my Excel sheet here. We're going to buy it, call it 9. Let's call it 10-1-2025. There's a reason I'm doing this. And then we have $3.5 million here. Now, this is where it starts getting into some of the art. You have to kind of know what things are doing right now here. Right now, let's just say we can get a 25 amortization at 75% at 6.75 interest rate here as well. So that's what we're going to do right there to build our loan analysis. And now we have this first tab ready to go. What I'm then going to do is goes back to the numbers here. If you remember this, come back to our rules of thumb here. First thing I'm going to do is I'm going to start looking at what is the financial documents, the history, what is the rent roll. So I'm going to pull up, I'm going to go to this rent roll tab here. You can see here. And in this example, we have 36 units here. So I'm actually going to take this, I'm going to extend it out another 13 or so we can get a good synopsis here. We're going to take this, we're going to drag it down, and lo and behold, I did it perfectly. 49 units, which is what this property is. I'm going to drag and copy there, and we're going to drag and copy here. And one more time. And we're going to drag and copy there. Already done. Okay. So we have 49 units here. We're going to make sure this all says 1 over here, just for my analysis, for anybody following along with me. So it says 49 units here, all 2-bed, 1-bath. Now what we're going to do is goes back to again pulling up historical numbers. We're going to pull up the rent roll here. So if you can see this rent roll here, this is a really old one here. It says rents are $560, $600, $525, and all the way down here. Now in this case, it says $27,480 for 48 units here. So we're going to just take this real quick here. I'm not going to put all these numbers in. In a full scenario example, we put all these numbers right here in this Excel sheet, so it matched up perfectly. But because of time, we're going to do this a little bit faster. I'm going to take 27,480 divided by 48 units. Means the average rent is $572.50 here. So we're just going to put 572.50, and we're going to take that and we're just going to drag it all the way down here to come up our numbers, and it says 28,052.50, 27,480 here because it does only show one extra unit there as well. So it should be right there as well. Now this comes back to where it's really important to do your rental expenses, your growth rate over here, this number at this one here, rental increase historically. This is what we're going to do here. So these numbers here are going to translate, in my model, are going to translate automatically into this. This is why it's so important to put our month, because you see October, November. My Excel sheet breaks down by the month and it does a 10-year analysis. So what I'm going to do here is I'm going to break this down. I'm going to drag that over, and we're going to drag this all the way out for 10 years. And so now we have a 10-year analysis. So 10 years, if rents go up by 2% per year, and 10 years will be up at $684 per rent. You can see here, September 2035. So that's our rent model. So now we have our income already built. In this example, we'll just say we have no laundry income, extra income. We're going to keep it really simple here as well. So you can see these numbers in my Excel, you're going to start populating here. But now we know what we're bringing in per rent, and that's going to be a per rental basis on the annual income. So it's really important for commercial real estate, for anybody looking and watching. We want to make sure we're always analyzing things on an annual basis, not monthly. Annual is how we do everything, 12 months. And so this 28,000 times 12 months creates this. And actually in this case, we have 5% vacancy rate built in, which this vacancy rate should pull from your market assumptions as well. We could actually put in, let's put in 6.09 instead of our vacancy rate to match up perfectly with that as well. So we now have our income solved. Now, if we go back to our model here, we have our income solved. We have our financial model being built here. Now we need to start looking at, we have the rents. We've done our location analysis. That was our market analysis right up front. Now we are going to go to our next model, which is figuring out the expenses. Begin with the big one, taxes. For anybody who's in Iowa knows, Iowa taxes are very wonky and weird. We have a whole tab built for it here. By the way, this is your debt tab. It's going to automatically pull from your executive summary tab, in my model at least. And you're going to show expenses here as well. But for our taxes here in Iowa, we're going to pull this here as well. So in this case, we're going to pull up the assessment, and we're going to pull this up and do 331515. And it's going to pull up its Sanger properties here. And so this is a great example here. Properties for Iowa reassess every 2 years here. So what we're going to do is we're going to go to this estimate your taxes tab right here. This is again Iowa based as well here. What we're going to do is you can see numbers here. You can zoom in. 321,000 what we want. That's the number we want. 321,000 for the land value. So we're going to type in 321,000 here. We're going to type in 2899 for the next one. 2899. Put that in, 3.2 million. Now, Iowa, we have a rollback. That's what you're seeing right here, 0.444590. So we're going to want to add in our rollback here. Iowa is just weird, 0.444, and we have 590 as well. So it's being taxed like a residential rate here. So we'll make sure we add that in. And then we have to put in our levy rate. Our levy rate you can find right here, 0.423446, 0.423446 as well. We're going to take that, we're going to take that, we're going to pull that all the way down. 60,619, 6,590. Did we miss them? 4232. 42, here we go, 32. Made a mistake, looks like, on my numbers. Make sure these add up. 60,590, 60,590 is good. So now we know, after we looked at our rental, we looked at our expenses, we've seen that this current assessment matches. Now, when you buy a duplex, a fourplex, a multi-family property in Iowa, it can change where you're at, but you can face potential reassessment when taxes go up, or property taxes go up as well. Property taxes go up all over the place. So we want to adjust and figure out what taxes are going to be next year, because those are expenses for us. I know in high growth markets, you're seeing taxes go up extravagantly high all over the place. So right now it's assessed for 3.2 million. Well, we're going to offer 3.5 million, let's say. So let's say that the property just goes up marginally. We're just going to put 350,000 here and 3,150 here and 3.5 million here. Now we're just going to copy these rollback numbers in this case, and we're going to copy this levy rate. And it looks like taxes could go from 60,000 to 65,000 next year as well. So in this executive summary here, it's going to pull that say, hey, 6,000 is already built in. We'll talk about what that looks like here, and it may or may not change. Now we start getting into some of the historical numbers here as well. And this is where we come back to the underwriting here. If you want to do this quicker, you could just jump in and put in one of these numbers here and make it really, really quick, really, really fast. Otherwise, you can actually dive in to the historical expenses and see what it looks like. For example, here's historical expenses of this property when I had it listed, which would have been January 2021. So you can see this was 4 or 5 years ago. This is where you can start jumping in and figuring out, okay, where's the extra income? You can see here, this guy's extra income from other income, late fees, eviction costs, etc. here. And this is where we start looking into the expenses, building maintenance, appliance maintenance, auto expenses here. Auto expenses won't really apply to everybody. That should be another write-off that some accountant's taking. Clerical expenses, electricity here. So this is where we can start playing with this here and adding all of these numbers in to what it looks like here. So in this case, I'm going to just start putting in some numbers here that I know work. So for property insurance right now, for Iowa, it's about $600 annually per number of units here. So we're going to do 600 times 49. So it's going to be about $30,000 of insurance. Now, if we look to this gentleman's project here, you can see I pulled up at the very top. His insurance right now is $26,000 on this project. So actually pretty much in line. That's okay. This is, again, where some of the art comes in, where you need to have insurance people with you, understanding how these things work. A good agent will help you with these projects as well. So you really need to make sure you are underwriting all these at the best rate. Now, this is where, again, this is going to start becoming the art and the science for all of these things. So I want to make sure we are clear on that. As we come through all these extra numbers here, we can put in what we want. You can see here it says 28% expense to income ratio, but we know this project being older, because it was built in 1950, should have 60% expenses or so. So after we have insurance done, we're going to go to the next big one, which is gas and heat. In this case right there, we have gas and heat, 6438, but again, it's a 6438, but it's only on 1, 2, 3, 4, 5, 6, 7, 8 months. So we have to do 6483. So we have 64883 divided by 8 is our number. And then we have to take that times 12, and that's going to be our gas and heat for the bill. Electricity, we're going to look at that, $39.2755. We're going to do $39.27.55 divided by 8, and then we're going to take it times 12 here. So let's build that formula in. This is where it becomes a little bit tedious here. And then we're going to go to the next one here, water and sewer here. I believe we saw water and sewer. Where are we at? Insurance, electricity, legal, management, office, other, plumbing, snow, supplies. There we go. Water, sewer at the very bottom there. So there's our number, 16,398. So we're going to do equals 16,398 divided by 8 times 12. Put that number in there. We already have that. Pest control. Does he have pest control in here? I believe he did. We're going to add that in right there. 3547. Again, we're going to take equals 3547 divided by 8 times 12. And we have that. Trash services. I believe we have that as well. We're going to go up and look where we can find that. There it is. So we have trash removal here, 3345. So we're going to do 3345 divided by 8 times 12, 5,000. Cable and internet, he does have that in there, I believe. There we go. 769 looks like. 769 times, divided by 8 times 12 equals there. We're not going to buy maintenance. Now supplies and repairs here. So this is where we're going to go up to supplies and maintenance. Some of them split it all out, some do not. So right here we have building maintenance and repairs, 21,000. And we have general repairs here as well of 6,000, I believe. Nope, $600. So 21,541. So we're going to do 21,541 divided by 8 times 12, and that number's there. I will say this is 10% repairs maintenance of the gross income. That is pretty accurate, by the way. So that's a good number to shoot for a project like this as well. Now we're going to go down. I know these most numbers aren't going to be here. The most common one next is landscaping, lawn care, snow removal here. So we're going to look for landscaping. There we see it. We have 1335. 1335 divided by 8 times 12. And then we're going to have snow removal as well coming down, 2040. So we're going to do 2040, 2040 divided by 8 times 12 equals 2040 divided by 8 times 12. There we go. Capital improvements, we're going to keep that 0 for right now. Cleaning supplies, I believe he had clean in here as well. Janitorial services, also known that, 3720. So we're going to do 3720 divided by 8 times 12. Going to get that one in there. And else we have an expense, we're going to build in management expense. I believe he may have some of that. Management fee here, which is 7,800. Add it up together, equals 7,800 divided by 8 times 12. That's very low expense, by the way, for management. Usually you're going to be between 5 to 10%, so that's very low. This is where the art comes in, knowing some of those numbers here as well. And after that, most of the other stuff's not going to be in here as well. You can see 62% expenses to the income. This is right in line with this project being a C, D class apartment complex, right in line here. However, this project, I also know from selling it older that it was running almost this D class here, but it was a C class apartment complex. So I know looking at this that there's an income problem automatically off the bat right away. Just because I know some experience for so many times. But now that we have our numbers here, we can start to look at, okay, what is our cap rate? So our cap rate is what we're going to call the income, the annual income, minus the total annual expenses. That creates what we call our net operating income. We take our net operating income divided by 3.5 million, and we are going to create a cap rate of, in this case, 3.41%. This is how we evaluate commercial properties. The most commonly, which is on cap rate, which again is annualized gross income minus annualized expenses equals your net operating income, not including your mortgage, not including any banks, and then you take that number divided by what price you want to offer, and that becomes your cap rate. For what this looks like here on my Excel sheet, this is your annualized return over a 5-year period. You're going to lose about $100,000 your first year based upon current numbers here. And this, I'm not going to, it looks like this cash flow numbers, return on equity, return on investment, etc. as well. So this is how we do it going forward here. But like I said, this is just one example of how the property is performing right now. This is just how we get to base one. If you want to do a more thorough analysis here, we need to take these same numbers and realize that our rents are only at $525. But if we pull up our old numbers, or our actually web here, apartments.com, we know that rents are much, much higher in this area as well. Also, if we pull from CoStar, we know that rents are about $1,100 per month. So let's just say, for example, we pull out and see, just for fun, see what rents could do, what this property could do if it goes up by a lot more. Let's see what it comes up with. Take these numbers here, and we're gonna pull them down. And again, this is all using my Excel sheet, everyone. So if you are wondering about analyzing this here, you can either hire me to help you analyze these projects, or sometimes you have your own built for these as well. I got really lucky again, did it perfectly. Did that. We're gonna take that, and what we're gonna do this time, instead of putting in $525, we're gonna put in $1,100 a month. Let's just say, for example, we're gonna drag that all the way down, and in that, whoops, was way too much. Let's drag down a little more, and let's drag down a little more. And in this case, we're gonna take this and copy, because we're gonna have rental growth coming in, which we will see. We'll drag that all the way over. And in this case, if we get to the market rate rents, in 10 years, rent should be $1,607. As you can tell, it's a much different number than what it was if we kept rents where they're currently at. So we zoom all the way out, and now we're getting almost double the income coming in here. So now we're gonna look at the same numbers here. We're gonna put in $3.5 million. Same numbers, we're gonna put in 10-1-2025 here, 10-1-2025 here. And we're gonna have 25%, 6.5% interest rate. I believe that's what we had over here. 675, excuse me. 6.75. This is where it's important to have a good banker on your hands. Now, this is where we know it's gonna cost some money to get the rents up. It's not gonna just happen overnight. We're gonna have to put some money into force the appreciation. Really common multifamily, people want to force the appreciation. Let's say it's gonna cost $20,000 per unit to fix up. So it's going to cost you $1 million to fix this property up. So we're going to put $1 million in there as well. So you're going to put in $875,000 down and plus another $1 million. So $2 million renovation. You're going to be in for $4.5 million here. But your income is much, much higher now. What we can then do is take our numbers, and we're going to pretty much just copy and paste a lot of things now. We're just going to take these numbers here. We're going to just take that copy, and we're going to paste it in here. And then our rent roll is already built in, and we are going to just take all of our numbers from the executive summary here, all the current numbers. This is where you can get a little bit more into the art and science of it all. It all depends. But let's just take these numbers here, and let's copy them for simplified math, and let's just paste them all in here. So in this case, if rents keep going up, rent rates go up, and we get the rents market up, you're buying it for a 12% cap rate. Well, this is why it's important for us to look at the market and analyze things. Also look at two different metrics. If we look at how the property is just performing at $3.5 million, we're going to say, wow, this project's performing. We're not going to buy this at a 3.4% return. It's a terrible deal. It's a bad cap rate. But if rents go up, it could be a 12% cap rate. Now we're getting a huge return. You can see here, we're hitting almost like in 5-year time, we're almost doubling our money. It's crazy level number of returns. We're hitting all of our good metrics here. Well, let's just say the project doesn't do as well we thought. Let's say it goes more to maybe a medium case scenario. Let's say we do $1 million renovation again. Let's add some numbers in here. And we do the same $3.5 million here. And we do 10-1-2025 here. And we do 6.75 here. And in this case, we're going to see taxes go up a bunch. In this case, where again, we run multiple models. We're going to go all the way over to my worst case scenario, debt taxes. We're going to put that in there. Taxes are going up. We're going to find the rent roll, and we're going to add in 13 more lines, give or take. See what this looks like. Here, and we added one extra one, so we're going to delete those 2 lines. I'm going to take that, and let's just say we say, hey, you know what, we think rents are going to go up. We do think that this $500 per month rent is way too low, but we're not going to go up to $1,000. Let's just say we're going to do right in the middle here. So, you know, it's not going to be $572 a month. That's way too low, but it's not going to be $11 a month. That's way too high. Let's say we're going to run our rent rate at, call it $775. And I think right now for a 2-bedroom apartment in the east part of Des Moines, $775 for a 2-bedroom market is going to be doable here. So let's put that in as a number. Let's see what it looks like. We did too far, but let's see what we can do here. 775, and we go 775 as well. We're going to pull down one more, and let's see what the numbers look like if rents were just about market rate, which is about 775 here, I think. I don't know why it's not pulling. That's why. Too many lines in here. Let's delete that for a hot second. There we go. Now we're perfect. And delete this out. And we're going to drag this all the way out over 10 years. Again, just based on my model, it's how my model works. Everybody's model is different. This is just how I underwrite properties. And we're going to do that. And we're going to drag it down. And now we're going to get rents coming in about $38,000 per month. We're going to take all these expenses. We're not going to do our taxes because that's going to automatically pull from the tab itself. So we're going to take all these and we're going to copy and paste them for simplified answers into here. And now you can see our expense ratio is 47%. So you can see again, if you remember the metrics we talked about, here's 32%, way too low almost. This is probably more accurate, 50%. This comes back to the rules of thumb that we had over here. It's all kind of translating, coming in line, all working out pretty nicely, you can see here, to kind of show it here as well. In this case, the property cap rate would be 6.37%. So you can see there's a big metric here between 6.3, but we're also looking at our equity amount, 1.87 million. That's these numbers pulled together. We really want to figure out what's our return on our equity. Not great, but our cap rate's okay. So these are why it's so important to look at the numbers here and look at multiple metrics here. Now what we're going to do is this Excel sheet that I have is built in. We're going to run the models and we're going to run it at, it's actually probably 20% chance it's going to happen here, 20% chance of likelihood. So these are likelihood opportunities here. And what my model will do is it's going to pull in all these numbers automatically to make it a lot simpler to look at this here on 3 different metrics of what could or couldn't happen. So we're going to do that there, do that there, do that there. We're going to put in the same 20% here because I think that's probably accurate. And we're going to put in most likely scenario is going to be 60% chance here. 60, 60, 60, 60, 60. And what this is going to do, these all have to equal 1. So you see 60 plus 20 plus 20 all equals 1. 60% likelihood here, 20% here, and 20% here. These models are going to weight out. Looks like we're buying at a 7% capitalization rate on a weighted analysis, and it's going to work out to about a 5-year return of cash flow here. 5-year cash flow will be $50,000 per year. 20% return on equity annualized over a 5-year period. 50% return on investment, so about 10% annualized over 5 years, with about a 4% return on your equity. You're going to put a lot of money into it here, but you're also going to get a lot of debt pay down, force the rents up, get some good cash flow out of it as well here. And that is really quickly and a very quick analysis how I analyze multifamily deals. And then one marketplace here, I took it through on a very quick analysis here. But for anybody looking again, that's what we just did. We analyzed this here. We went through all these steps at a very quick high level here. We analyzed the market. We looked at a property historically speaking. We broke down, how far it's going to be. So we looked at the map here. Figuring how many properties are in the area, population, rent growth, number of units, etc. Here, your market assumptions, which are here. And then we built in some different scenarios, what could or couldn't happen on the property. This is, again, how it's forming now. No capital improvements. We looked at how we could build it with some capital improvements, about $20,000 per unit, get those rents really jumped up. Best case scenario, 12% cap rate. Worst case, we're going to be at 3. And then medium case scenario will be about 7. And then we ran a comprehensive summary analysis to see what it looked like in total here as well. That's how we did it all. Some of these numbers I threw out there were probably pretty high level, cap rates, IRRs, capitalization rates, that kind of thing as well. But that is how we analyze a multifamily deal for anybody out there that's been watching and following along with me here. So I'm going to pull this up for anybody still live. I don't know if I have any viewers or not, but that is how we do it here. For anybody that wants to rewatch this, has questions, feel free to reach out to me and let me know. But that is analyzing multifamily deals in Des Moines, Iowa at a high level here. So for any questions, throw them in the chat for me, and I'll happily answer what I can. Otherwise, I'm going to let everybody get back to their day. And again, as always, you can reach out to me here. Jared Husmann, just message me on Facebook here, DM me, direct message me here, and we'll be happily chatting about what it looks like to analyze multifamily deals here in Iowa. That is all I have. And again, I'm going to let everybody get back to their day. Thanks for tuning in.